Within 36 months, $3 trillion in Chinese Treasury holdings will exit the system. We're at stage 4 of a 7-stage liquidation pattern. Here's why your mortgage rate, grocery bill, and retirement account are about to reprice violently. Picture the scene, a mahogany conference room in Beijing. Screen displays Treasury auction results. Bid to cover ratio, 1.87, lowest in 15 years. The State Administration of Foreign Exchange reviews a single-page memo. Subject line, Vendor Financing Exit Protocol, Q1 2025. 3 decades of trade surpluses sit in U.S. Treasury securities. $3.1 trillion, yielding 4.2% while dollar inflation runs 3.8%. Real return, 0.4%. Debt to GDP, 124%. Annual deficit, $1.7 trillion. Maturities to refinance, $7.6 trillion over 24 months. They've seen this balance sheet before. Britain, 1945. Sterling reserves, safe haven, until the devaluation. The question isn't if China exits, it's whether anyone notices the settlement rail infrastructure going live before Treasury auctions start failing. This is stage 1 of the liquidation pattern, bubble. Here's why this matters to you. The cheap imported goods at Walmart, low mortgage rates for the past 15 years. Your retirement account's safe bond allocation, all rest on $7.2 trillion in vendor financing about to unwind. Foreign central banks, led by China, hold more U.S. Treasury debt than entire U.S. GDP. This is the largest creditor-debtor imbalance in human history. The boardroom reality, China runs a $300 to $400 billion trade surplus with the U.S. annually. They ship containers of electronics, clothing, machinery. They receive dollars. Those dollars must go somewhere. Beijing, Tokyo, Riyadh, Treasury management divisions staring at the same math. You're lending $7.2 trillion to a borrower with 124% debt to GDP, $1.7 trillion structural deficits, and no political mechanism to consolidate. The borrower prints the currency you're denominated in. This is vendor financing, forced lending. You're not investing, you're trapped. Here's how the trap works. When China exports $500 billion more than it imports, Chinese companies receive dollars. Those companies convert dollars to yuan at Chinese banks. Banks deliver dollars to the People's Bank of China. The PBOC now holds dollars. But what do you buy with $400 billion in annual dollar receipts? Not Chinese stocks, foreigners would own domestic assets. Not yuan, and that creates appreciation pressure, making exports expensive. Not euros or yen, those markets can't absorb $400 billion annually. The only market deep enough to absorb $2 to $3 trillion in flows over a decade is U.S. Treasuries. China doesn't buy Treasuries because they want 4% yields. They buy because the alternative is letting their currency appreciate 30%, which destroys their export model overnight. So they lend the money back to the customer. The U.S. runs deficits, imports Chinese goods, and China funds the deficit by buying the bonds. It's a closed loop, a circular dependency, running for 30 years. Here's what this means for you. That $7.2 trillion in foreign treasury holdings equals $21,500 per U.S. household in vendor financing. It's allowed the U.S. to run $800 billion trade deficits every year. Your living standard is 20 to 25% higher than fundamentals would allow if trade had to balance. The cheap TVS, affordable smartphones, low mortgage rates, all subsidized by foreign central banks trapped in vendor financing. But circular flows have a breaking point. Britain's sterling area ran for 40 years. Then creditors tried to withdraw. That's when they discovered the vendor financing wasn't wealth. It was a claim on a balance sheet that couldn't honor redemptions. You might be thinking, China can't exit treasuries, they'd destroy the value of their own holdings. It's mutually assured destruction. Here's the problem. Once debt to GDP crosses 120 to 130%, history shows sovereign borrowers face a choice: inflate or restructure. The U.S. can't restructure, politically impossible for reserve issuer, so they'll inflate. That means China's $3 trillion loses 30 to 40% of purchasing power over the next decade, if they hold. The rational move isn't to protect current holdings, it's to minimize future losses. Exit before the fire sale. Sterling creditors learned this in 1949. The ones who exited early took 20% haircuts. The ones who stayed lost 50% or more. That's stage 1, the bubble phase, where vendor financing looks sustainable. Stage 2 is where the math breaks, where primary dealers discover they can't absorb what foreign central banks are selling. This is stage 4 of the liquidation pattern. We're entering it now. Here's why this matters to you. Every 1% rise in Treasury yields adds $340 billion in annual interest costs. That's $1,000 or more per household in higher taxes or deeper deficits. We're watching Treasury yields spike from 4.5% towards 6 to 7%, while foreign central banks reduce holdings by $500 billion in 24 months. Your mortgage rate is about to jump $600 to $800 per month on a median home. The boardroom reality: U.S. Treasury auctions happen weekly. $2 to $3 trillion in new issuance annually, plus $7.6 trillion in maturities to refinance over 24 months. Foreign central banks historically absorbed 30 to 40% of issuance. That demand is disappearing. Someone else must buy. A Treasury auction on Wednesday afternoon. The 10-year note, $40 billion offering. Primary dealers, the 24 banks contractually obligated to bid, are already holding $900 billion in treasuries from previous auctions that foreign buyers didn't take. Their capital is finite. Risk limits are binding. The bid-to-cover ratio comes in at 1.94. Healthy auctions run 2.3 to 2.5. Anything under 2.0 signals distress. The yield jumps 15 basis points. This is stage 4, the margin call. The market is discovering price. Here's the mechanism. Primary dealers must bid at every auction. It's contractual. If foreign buyers and domestic institutions don't show up, primary dealers absorb the slack. They warehouse the bonds, then sell them over time to real buyers. But when they're holding $900 billion in treasuries waiting for buyers, and foreign central banks are net sellers, reducing holdings $500 billion per year, the math breaks. What happens when the next $40 billion auction comes and dealers are already at capacity? They bid, but only at yields high enough to compensate for the risk. Yields spike. 4.5% becomes 5.5%. Then 6.5%. Then 7%. The auction still clears, there's always a price, but the price discovery is violent. Treasury yields are the risk-free rate, everything else prices off them. Your mortgage is Treasury yield plus a spread. When the 10-year yield jumps from 4.5% to 7%, your 30-year fixed mortgage goes from $2,400 per month to $3,200 per month on a median $400,000 home. Housing market freezes. Your home value drops 25%. The fire sale creates a doom loop. Higher yields mean higher government borrowing costs. $340 billion more in interest per 1% yield increase. That widens the deficit. Wider deficits mean more borrowing. More borrowing into a market with falling demand means yields rise further. Self-reinforcing. Britain faced this in 1947, 1949, 1967, 1976. Each time temporary yield spikes became permanent repricing. You might be thinking, the Fed will just buy the bonds. They'll cap yields like they did in 2020. Problem solved. But here's the problem. When the Fed buys treasuries, they print money. In 2020 to 2021, the Fed bought $4 trillion in assets. Money supply grew 26% in 18 months. Inflation hit 9%. That was with foreign central banks still buying. Now imagine foreign central banks are net sellers, removing $500 billion per year, while the Fed tries to buy $2 to $3 trillion to fill the gap. Money supply growth hits 15 to 20% annually. Inflation returns to 6 to 8%. That destroys the safe haven narrative. You're saving the auction by destroying the currency's credibility. That's stage 4, the margin call, where auction mechanics break. Stage 5 is where the Fed steps in with rescue financing, which, as Britain learned in 1976, comes with covenants that transfer governance. This is stage 5 of the liquidation pattern. We're entering the rescue phase. Here's why this matters to you. When the Fed prints $3 trillion to buy unsold treasuries, your savings lose 30 to 40% of purchasing power over 3 years. Inflation returns to 6 to 8%. Retirees on fixed incomes get destroyed. Your 401k balance might stay the same nominally, but it buys half as much. This is the hidden covenant. The Fed saves the auction but confiscates wealth through debasement. The boardroom reality. Treasury auctions are failing. Foreign buyers are gone. Primary dealers are at capacity. Yields are spiking towards 7 to 8%. The political system can't accept those borrowing costs, $3 trillion or more in annual interest expense, so the Fed announces temporary quantitative easing. Balance sheet expands from $9 trillion back toward $12 trillion. They buy what no one else will. Federal Reserve Board meeting. Powell's successor faces the impossible choice. Option A, let yields spike to 8%, triggering recession, housing collapse, and federal government interest costs exceeding $3 trillion annually. Option B, print money, buy treasuries, cap yields at 5 to 6%, but destroy reserve currency credibility through inflation. There is no option C. Britain faced this same choice in 1949, 1967, 1976. They chose inflation each time. Devalue, print, inflate. Why? Because restructuring is politically impossible for a democracy. Austerity governments fall, so they chose slow confiscation via currency debasement instead of fast restructuring via explicit default. Here's how Fed monetization works. Treasury holds an auction. $50 billion in 10-year notes. Foreign buyers, 0. Domestic institutions, $15 billion. Primary dealers forced to bid for the remaining $35 billion, but only at 7.5% yield. The Fed announces a temporary program to maintain orderly markets. They buy $30 billion of the auction at 5.5%. This caps the yield. Auction clears. Crisis averted. But here's what actually happened. The Fed created $30 billion in reserves out of thin air, used those reserves to purchase government bonds, and expanded the money supply. Money supply growth plus limited real economic growth equals inflation. It's arithmetic. M2 money supply grows 15% annually. Real GDP grows 2% annually. The difference shows up as prices. Your grocery bill, gas, rent, all rise 8 to 10% annually. Over 3 years, your purchasing power falls 25 to 30%. The Fed rescued the Treasury auction, but your savings paid the bill. Here's what this means for you. The Fed expands its balance sheet by $3 trillion over 18 months. That's $9,000 per person in new money creation. It doesn't show up in your bank account, it shows up as higher prices. Gas goes from $3.50 to $6.50. Groceries up 40%. Rent up 30%. Your fixed income grandparents on Social Security and pensions, their $3,000 per month loses half its purchasing power. This is how sovereigns default in the modern era, not explicit restructuring, but theft through inflation. The inflation creates a spiral. Workers demand higher wages. Businesses raise prices. Fed is trapped. If they tighten policy to fight inflation, they crash the Treasury market. If they keep printing, inflation accelerates. This was Britain in the 1970s. Inflation hit 25% by 1975. IMF had to step in. You might be thinking, but inflation can be controlled. The Fed will just raise rates once the crisis passes, like Volcker did in the 1980s. Here's the problem. Volcker could raise rates to 20% in 1981 because debt to GDP was 30%. Interest expense was manageable. Now, debt to GDP is 124%. Every 1% rate increase adds $340 billion in annual interest costs. Raise rates to 8% to fight inflation, you add $1.2 trillion in interest expense. The deficit explodes from $1.7 trillion to $2.9 trillion. You're fighting inflation by making the debt crisis worse, which requires more Fed printing, which creates more inflation. You're trapped. That's stage 5. The rescue that's actually wealth confiscation via monetary debasement. Stage 6 is where creditors exit the currency entirely and rebalance into hard assets. That's when gold hits $3,500 or more, and oil producers demand non-dollar settlement. This is stage 6 of the liquidation pattern, asset stripping. Here's why this matters to you. When central banks abandon dollar reserves for gold and hard assets, the US loses pricing power on everything we import. Oil, rare earths, semiconductors, pharmaceuticals, all priced by sellers, not buyers. That $1.50 per gallon at the pump, that's the beginning. Your 401k might show a nominal balance, but it's a claim on depreciating paper while real wealth flows to commodities and productive assets offshore. The boardroom reality, China's PBOC reviews its reserve composition. $3 trillion in treasuries yielding 4.2%, while inflation runs 6% equals negative 1.8% real return. Gold is at $2,400 per ounce. No counterparty risk, no inflation risk, no sanction risk. The decision isn't theoretical. It's risk management. Exit the depreciating paper. Rebalance into hard assets. Central bank gold buying programs. Not retail investors buying coins. Central banks buying 100-ton lots. China accumulates 200 tons per year, officially, likely 400 tons or more including covert purchases. Russia adds 150 tons annually until sanctions hit. India, Turkey, Poland, all building gold reserves while reducing treasury holdings. Gold has no credit risk, no inflation risk, no political risk. Treasuries have all three. When you're holding $3 trillion in vendor financing to an insolvent borrower who controls the printing press, the rational move is asset reallocation. Not all at once, that's a fire sale, but 5 to 10% annually. Over a decade, $3 trillion becomes $1.5 trillion. The other $1.5 trillion goes to gold at $3,000 to $3,500 per ounce, commodities, and alternative currency reserves. Here's the mechanism. Central banks don't announce we're selling treasuries to buy gold. That would crash the treasury market and spike gold prices before they finish the trade. Instead, they do it quietly. Reduce treasury holdings by 3 to 5% annually. Let maturities roll off without reinvestment. Use the proceeds to buy gold through intermediaries. The rebalancing happens over years, not months. Gold purchases, 1,200 tons annually across all central banks, triple the historical average. That's $72 billion per year at $2,000 per ounce. Not enough to move the market violently, but enough to steadily drain dollar reserves. Over 10 years, that's $720 billion exiting treasuries into gold. Once the pattern becomes clear, private investors follow. Sovereign wealth funds, pension funds, insurance companies, all rebalance toward hard assets. The dollar loses safe haven status. It's not a currency people flee to during crisis anymore. It's a currency people flee from. Here's what this means for you. The U.S. imports 50 to 70% of critical goods. As dollar weakens and alternative settlement rails go live, producers demand non-dollar payment or apply a premium to dollar transactions. Saudi Arabia announces yuan settlement for Chinese oil purchases, 10% discount versus dollar pricing. That 10% flows through as $1.50 to $2 per gallon at your local gas station. Your import costs rise 25 to 35% as the currency premium disappears. You might be thinking, gold can't replace treasuries. There's only $15 trillion in above-ground gold versus $100 trillion or more in global financial assets. Here's what you're missing. The reserve system becomes multipolar, not gold only, but 30% dollar, 20% euro, 15% yuan, 15% gold, 10% yen, 10% other. The US doesn't lose reserve status entirely. It loses the monopoly. That's what matters. Monopoly equals exorbitant privilege. Lose the monopoly, and every future treasury auction prices in the risk premium. That's $500 to $700 billion in additional annual borrowing costs. Forever. Your household share, $2,100 per year in higher taxes or reduced services. That's stage 6, the asset stripping phase where smart money exits paper for hard assets. Stage 7 is the new equilibrium, where the US is just another country that must balance its trade and pay market rates. This is stage 7 of the liquidation pattern, the new equilibrium. Here's why this matters to you. When the dollar loses reserve monopoly, the US must run balanced budgets, not as aspiration. As binding constraint, no foreign creditors to fund deficits, no Fed monetization without triggering inflation spiral. Government spending falls or taxes rise by $1 to $1.5 trillion annually. That's $4,500 per household. Plus, import costs are 25 to 35% higher. Living standards fall 20 to 25%. Not temporarily, permanently. The boardroom reality, dollar settles 45 to 50% of global trade. down from 88%. Euro at 25%, yuan at 20%, gold and commodities at 10%. Yeah, the US pays 2 to 3% higher rates on all borrowing. That's $700 billion annually in lost exorbitant privilege. Plus, structural adjustment to balance trade. G20 Finance Ministers Meeting, circa 2032. The agenda: multipolar reserve system governance. The dollar is still important, 45% of reserves, down from 60%. But it's no longer the monopoly. China settles 40% of trade in yuan. Europe uses euros. Russia, Iran, Venezuela trade in rubles and gold. The petrodollar is dead. Saudi Arabia takes yuan, euros, rupees for oil. The U.S. Treasury Secretary attends, but doesn't dominate. The U.S. is one vote among many. When crisis hits, there's no Fed swap line big enough to save the system. No swift exclusion threat, credible enough to enforce terms. The leverage is gone. Here's what the new equilibrium looks like. Reserve composition shifts. Dollar 45%, euro 25%, yuan 20%, gold 10%. Settlement rails diversify. SWIFT still handles 60% of transactions. CIPS, China's system, 25%. Bilateral arrangements, 15%. U.S. borrowing costs, 10-year Treasury yields at 6 to 7% versus 4 to 5% with reserve monopoly. Annual interest expense climbs to $2.5 to $3 trillion. Deficit must fall to near zero. No foreign financing available. Trade adjustment. Current account must balance. Can't run $800 billion deficits. Imports fall 20 to 25% to match exports. Consumer goods prices up 25 to 35%. Manufacturing returns, but at higher labor costs. Without reserve currency monopoly, the U.S. can't print its way out of trade imbalances. Dollars flow abroad, but don't automatically return via Treasury purchases. So, trade must balance. That means living standards fall to match actual productivity, not subsidized consumption. Here's what this means for you. The new normal is 20 to 25% lower living standards, not recession. Permanent adjustment. Your $75,000 household income buys what $55,000 to $60,000 bought in 2024. Cheap imported goods disappear. Gas is $6 to $7 per gallon. iPhone costs $1,800 instead of $1,200. Your retirement account needs to last 30 years with 2 to 3% real returns instead of 5 to 6%. The exorbitant privilege wasn't free. It was borrowed from the future. This is the future. The geopolitical implications. U.S. military spending falls from $900 billion to $500 to $600 billion. On the overseas bases close. Security guarantees become conditional. The dollar's power was always tied to military hegemony. Without the currency monopoly to fund the military, the hegemony ends. America becomes a large, important country, not an empire. You might be thinking, this is too apocalyptic. Markets adjust. Innovation creates growth. America has overcome worse. But here's what you're missing. Britain had all those things too. In 1945, Britain was still a global power. Institutions, innovation, rule of law. But the balance sheet was insolvent. Debt to GDP hit 250%. When creditors exited, no amount of resilience changed the math. Sterling went from 60% of reserves to 3%. Living standards fell. It took 40 years to stabilize at the new equilibrium. If you understand nothing else, understand this. The US faces the same math. Debt to GDP at 124%. $1.7 trillion structural deficits. No political will to consolidate. At some point, resilience doesn't matter. The balance sheet matters, and the balance sheet says you borrowed 30 years of living standards from your future. The bill is due. That's stage 7, the new equilibrium where the U.S. is no longer the monopoly reserve issuer. It's not collapse, it's normalization. Britain survived, but they survived at 20 to 25% lower living standards. That's the balance sheet reality. The liquidation is complete. The question is whether we manage the adjustment or let it manage us. 7 stages. We're at stage 4. The vendor financing trap, stage 1, is visible. The auction failures, stage 4, are beginning. Fed monetization, stage 5, is 12 to 18 months away. And asset flight to gold, stage 6, is accelerating. The new equilibrium, stage 7, arrives by 2032. Britain took 30 years to complete this pattern. Sterling went from 60% of reserves to 3%. Living standards fell 20 to 25%. The adjustment was permanent. The US timeline compresses because the dollar's dominance is deeper, which means the unwind will be faster. The pattern is locked. The question is velocity.